Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending March 21st, 2025. Appreciate you all tuning in, liking, and subscribing to this video and this channel and our podcast, InvestTalk. Now, I'm Justin Klein, host of InvestTalk, and this week I'm titling the video, Markets Find Solace in a Dovish Fed. And also found some support as well, which we'll dig into on the charts here in just a bit. But I always like to start with this heat map, just so you can see what stocks did well this week, what sectors did well or not. And what you can see here is of the Mag 7, still a lot of general weakness. Amazon, Meta, Nvidia, all down. Broadcom still down over 2% on the week. But you did have a few winners, notably Apple and Microsoft. Tesla eked out a gain for the week, but that was after a really nice gain on Friday, so barely turned positive there. But you had names like Palantir, Netflix; those were higher. But from a sector perspective, you can see energy continues to be strong. Financials are got a nice bounce back this week, and so something I'll be watching to see if that sticks or not. That'll be certainly a strong indicator of the economy going forward. But consumer durables or non-durables, excuse me, those had a bit of a setback. Some down names in our overall green tape for the week, and that was of note. A lot of those names are probably a bit overbought, and you did see rates rise a bit on the 10-year. So if I zoom over here, you can see you had some of these names, or sorry, the 10-year sell off of the last couple of days. So you certainly could continue to see some backing and filling, at least in the non-cyclical areas like consumer durables, et cetera. But that was kind of the market this week. Definitely a nice bounce off of support, and I'll show the charts here in a minute. But let me get to the economic data. And on Monday, you had the housing market index, Wells Fargo. It did tick down to 39 for the month of March. That's always something to look at. Are we talking about March? Are we talking about February, et cetera? February retail sales, they did tick down a bit year over year, 3.3%. Still okay, not in negative territory, but overall, certainly tempering just a bit from where we are at the end of the year at 4.65%. The housing starts, that did tick up. That's a good sign, but building permits, those ticked down a bit. So kind of conflicting reports there. Export prices, that did tick down to 2.09% in the year over year. Now remember, these are export and import prices, especially. That's going to feed into inflation, at least on the goods side. So you had that tick up a little bit on the import prices, mainly because people or companies are starting to hoard inventory ahead of the tariffs, and so I think that's putting pressure upwards on prices there. Industrial production did tick down a bit year over year, but still on a nice upward trend overall since early last year. This was interesting of note to me is the tick flow data. So what this is showing you is foreign holding of U.S. Treasuries. Are they selling U.S. Treasuries? Are they buying? Sorry, not necessarily Treasuries, securities, U.S. securities. So since September, there was a pretty strong reversal here, and now in negative territory of money flowing out of the United States. And is it a coincidence that you had the dollar peak here back in kind of near year end? I don't think it is a coincidence. So if that continues, something I'll be watching is money flowing out of the United States due to instability and geopolitical winds that are happening right now. So based on this data, I do think the dollar is headed lower as long as that remains in negative territory. Existing home sales, that it did tick up a little bit, so that was interesting in February. So you're starting to get some traction. Now it's still at very low levels, but you can see a bit of an uptrend here, basically since the summer. So I'll be watching that. So the housing market slightly improving, but nothing major there. Continuous claims for unemployment insurance, that did tick up to the high level of this range. We're not breaking out of this range. So I think the labor market is kind of steady state at the current time. And then we get into the Fed meeting. We had the Fed meeting this week, and they were overall dovish. Yeah, they didn't cut rates, but they still remained on path to cut rates 2, maybe 3 times this year. and they started to wind down QT. Now, I thought they were going to signal that they were going to talk about that next meeting, but no, they actually are doing it starting in April. So they announced a reduction in quantitative tightening, and that is from 25 billion of treasuries being allowed to roll off every month, now down to 5 billion. I'm not sure why they left the 5. Might as well just get rid of it, but I'm sure they will at the next meeting. But they are allowing those mortgage-backed securities to roll off, and that is so QT is still there, and I believe it's mortgage-backed securities at 35 billion, Treasuries now at 5 billion, so that's 40 billion in roll-off, but that's down from 60 billion. So they cut it about a third. My guess is they drop the mortgage-backed security roll-off to 20 at the end of for next meeting, and then get rid of any treasury roll-off at all. And so probably inching their way over 3 meetings to get off of QT. Then the question is, do they start doing QE in the back half of the year due to the refinancing cycle in the corporate bond market? I think that's increasingly likely. But overall, the market liked that. The market liked that the Fed is inching towards more cuts, less QT, potentially more QE. That is bearish for the dollar, good for liquidity, good for asset prices in general. So that was the overview of the economic data and the Fed meeting. But let's get into the charts here, and I'll just start with your classic SPX. So S&P 500, what you can see here is from the yen carry trade lows to the highs, you found support right at that 618 retrace, right at the 5,500 level on the S&P. Not a shock here. Also, this area where you had that first initial thrust, pullback, and then launchpad from there. So all of this is good support here on the S&P. If you get below 5,500, especially this 5,400 level, you're probably going head straight down to 52 and probably the low here around 51 from, once again, the yen carry trade lows. So now that's, I think eventually, I do think near term, you did have option X week. Option quarterly OpEx was this last Friday, and you are getting likely a trend change, at least in the short term. You typically get that after OpEx, and we have a big announcement on April 2nd. That's when Trump is going to announce really what tariffs are going to be implemented. Now, who knows what he's going to say? He did float flexibility on those tariffs late Friday, so that I think helped spark a late day rally in the S&P. If I zoom into a 5-minute chart here, see this one. There you go. So that did kind of spark this end of day rally here on the S&P. But overall, you still don't know what's going to happen. So between now and month end, so basically next week and into early the following week, odds are good you get a light volume float higher. Now, where would resistance be? Now, the first well, let's do a fib retrace here. High to low, right around there. So 5750 would be definitely good, so good resistance, 5825, but the real one is 5900, which also lines up pretty close to this right here. You see this candlestick here where you had the pullback and then rally higher and then fail. And this is really, and then you found support there, right? Try to rally a little bit, and then that's where it failed in earnest. And so that is what that's kind of the line in the sand for me. If we get above that and close above that for multiple days, I think we go to new highs. Not my base case scenario, but certainly something that is on the table, especially if the tariffs come in lighter than expected and the market is happy with it, and you have a dovish Fed, and Doge isn't really getting anywhere with any major cuts. That's going to derail the economy overall. Obviously, it makes certain people mad and all that, but it's not attacking defense spending, not attacking any major government spending that's going to spin us into deflation or anything like that. So that's kind of where we're at. My base case is a rally into 5,800 in that range, because this is also resistance here. So this pivot low which in this area, right around the 58.25 range, that's also going to be a bit of resistance. So there's definitely some nice overhead resistance in the markets. And I think you could float around up here for a little while before ultimately I do think you break this low. I do think that, mainly because this has thrown a lot of uncertainty into markets and but into economies, excuse me, less markets, more economies, sectors. A lot of what's happening with the tariffs is some echoes of what happened in COVID, which is freezing up supply chains. When you don't know what tariffs are going to be, you don't know what the cost of things are going to be. Are you really going to commit to purchasing or building a ton of new product? Probably not. Now you might try to get ahead of that, but if you know something won't be built or ready to ship for 3-4 months, are you going to build it not knowing exactly what type of market you have for it? Are you going to order in a ton of new materials and new components so you can build more of it without really having a clear picture of what's happening in the next 3 to 6 months? No. So that's a problem, and that freezes hiring, and it causes a lot of problems within the business community. So there definitely needs to be some clarity there, but still, I think the economic damage, at least in the short term, is done. Now, can it be repaired over time? Sure, but I do think this is going to continue to slow the economy the longer this uncertainty goes on. Now, does that mean once again that you can't have another month, 2, 3, maybe even 4 months where you get choppied up and maybe even go to new highs? I think that's certainly a possibility, but ultimately, I do think you roll over in the back half of the year, and a lot of it has to do with, as I said before, the corporate debt refinancing cycle that is likely to pull liquidity out of the market. And unless the Fed counters with QE and really heavy liquidity going into markets, I don't think that's going to hold everything up. Could be wrong. Obviously, I hold the right to change my mind over the next 3 to 6 months, but that's kind of my base case scenario. So, what we're doing is rebalancing on rallies, probably raising a little bit of cash, nothing major, but certainly thinking about pivoting to the sectors that have started to do well in the market right now. So that's kind of where we're at. Short term, I'm actually modestly bullish, but I'm starting to think medium term more bearish. Okay. Let's get over to the NASDAQ. And this is another reason why I'm a bit more bearish medium term is we've broken these uptrend lines. Look, however you want to draw these uptrend lines, we've broken them. And so I could easily see this kind of attempting a bit of a rally, a shallow rally, and then rolling over once again, especially in the NASDAQ where, there's a lot of names that are heavy. Look at NVIDIA. This is had a little bit of a rally, but still below all those major moving averages. And really threatening a downtrend, and it's in a downtrend if you look at it objectively. And same with the semiconductors. This is lower highs, lower lows. This is a downtrend. You go into XLK, just technology straight up. This is a massive reversal. Go zoom over to a monthly chart. And you had this topping tail here last month, and you're getting that follow through this month. And most likely, if you close below last month's low, this is a confirmation that this is a top in technology. So I'll be continue to watch that and see if we get a rebound next week and into April. Let's see what else. Let's go to gold. Gold prices did have a bit of a breather. Were we up this week? I think we were still up. Yeah, we were still up, but had a little bit of sell off into on Friday, but nothing really that crazy. Like I said, we have OPEX, so typically you get a counter trend kind of move as option dealers gamma hedging rolls off, and once again, that's in both directions. So you see names like GLD, gold prices that are trending higher, you get a bit of weakness on Friday. Whereas you go into like a Microsoft, this has got a bit of strength, even though that has been weak. Okay, so that's another reason why you had a lot of strength in some of these technology names on Friday. I don't think that's necessarily sticky, but that's more of a product of OPEX week. So I wanted to highlight that. Let's see, what else do we want to get into? Let's go to bonds, TLT. So, this goes up, means bond yields are coming down. They have come down, but the Fed was more dovish, and this didn't really move. And that's kind of a tell to me that it didn't really rally here. So I could easily see rates rising in the short term. So I'll be watching. I'll be certainly watching for that. But medium term, I would say I'm slightly bullish on bonds, mainly because of the economy slowing. But I wouldn't be. I don't have a strong opinion one way or the other. Let's be frank on that. This is a growth to value trade. You saw that big reversal. Like I've said, I do think value is starting to outperform once again. Now, this has been an uptrend, which means growth is outperforming, has outperformed since the bottom in the call of beginning of 2023. But what you can see here is this is 2021 top, and we did not recapture it. So in general, this is a topping pattern where this whole trend from '08, where growth is outperforming, this is distributive. This is what it looks like when a trend is changing. You have that initial large move, counter trend rally, and then probably a continuation. And we could be sparking that. And I think it would be in earnest if you close below the low from December. Yeah, that was December right here. So we'll be watching to see if we get that at the end of the month, or maybe next month as well. What else do I want to get to? We talked about the dollar a little bit. We can look at like the currencies. So here's the yen. So the yen carry trade, this is another aspect where it could unwind more positioning later in the year. If the dollar continues to get weak, the yen gets stronger, you start getting more of that yen carry trade unwind, right? If the Fed goes through an easing cycle, becoming more dovish, maybe doing QE, cutting rates, what's going to happen and what's happening in Japan, they're actually trying to raise rates. Now they're probably not going to do it aggressively. It's very mild, but that rate differential is starting to shrink once again. And so we'll be on the watch for that, but the yen is certainly in an uptrend. And then if you head over to the euro, this had a nice breakout a couple weeks ago and just consolidating here. So and this is all about the European Union stepping up and saying, hey, we can't rely on the United States for security anymore. We are going to need to open our checkbooks and stimulate the economy, build military equipment, and protect ourselves, because we can no longer rely on America anymore. And so that's certainly going to likely spark their economy overall, and that's why the euro is getting a bit stronger. Are there reforms that are going to take place, et cetera? So, and that's why another reason why I think the dollar is beginning to weaken. Let's see. Do I want to get to anything else here? I think that'll do it for this week, because I don't want to get too deep into the weeds. It's just it's been an interesting couple of weeks. Once again, I'll recap. We are at support, likely a bounce, likely a lower low, but going from 56 and change up to 59 and change, it's a nice little move on the indices. And that means a lot of the underlying stocks will move as well. You can see that. Look at the SPX volume on Friday. Those all have to do with OPEX. And it shows you just how powerful OPEX, option expiration can be. So, and with the notional value in the option markets becoming even more important to kind of short-term swings in the market. And so until we get some resolution on the tariffs, I do think you get a choppy float higher before, but you can get an announcement before, right? Trump can tweet something beforehand and suddenly move markets, and so you have to look out for that as well. But that's where we are. Support has held, will hold likely in the short term, but less confident that it will stay at these levels or higher in the medium term. Thank you all for tuning in and liking and subscribing once again to this video and this channel. And a reminder, that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.